Hedge funds represent a pivotal segment within the global financial landscape. They are complex and sophisticated investment vehicles designed for a specific class of investors. These funds pool capital from a select group of individuals and institutions, deploying it across a broad spectrum of assets and strategies. Their primary distinction lies in their structure and operational flexibility. Unlike conventional investment funds, hedge funds are not bound by the same stringent regulatory constraints. This operational freedom is a defining characteristic, enabling them to pursue unique investment opportunities. The investor base for hedge funds is deliberately restricted. These funds typically cater to accredited investors, individuals or entities meeting specific wealth and income criteria. Institutional investors, such as pension funds, endowments, and insurance companies, also form a significant portion of their clientele. This limitation is imposed due to the inherent complexities and risks associated with these investments. Regulators deem that only sophisticated investors possess the requisite knowledge and financial capacity to understand and bear such risks. Therefore, hedge funds are generally not accessible to the average retail investor. A critical aspect of hedge funds is their distinct regulatory environment. Unlike mutual funds or exchange-traded funds, which face extensive oversight, hedge funds operate under a comparatively lighter regulatory framework. This difference grants managers significantly greater flexibility in their investment decisions and strategies. While this reduced oversight allows for innovation and dynamic portfolio management, it also introduces unique challenges. Investors must conduct thorough due diligence, as the transparency levels can be lower compared to more regulated investment products. The regulatory landscape is constantly evolving, yet the core principle of flexibility remains. The investment scope of hedge funds is exceptionally broad and diverse. Managers can access a wide array of complex financial instruments and markets, often unavailable to traditional funds. This includes both public and private assets, domestic and international opportunities. Furthermore, hedge funds frequently engage in potentially riskier investments and strategies. This willingness to explore unconventional avenues is often what drives their pursuit of higher returns. The expanded toolkit allows for a more dynamic and opportunistic approach to capital allocation. The attractiveness of hedge funds primarily stems from their potential for high returns. Their sophisticated strategies and access to diverse markets aim to generate alpha, or returns exceeding market benchmarks. This appeal draws investors seeking growth and diversification beyond traditional portfolios. However, this potential for substantial gains is invariably accompanied by significant risks. The complexity of their strategies, combined with their less regulated nature, necessitates a thorough understanding of these underlying risks. Investors must carefully weigh the prospect of high returns against the potential for substantial losses. A core characteristic differentiating hedge funds is their ability to employ investment strategies typically unavailable to retail investors. These strategies are often intricate, requiring specialized knowledge, advanced financial models, and sophisticated execution capabilities. This expanded toolkit allows for more dynamic and aggressive portfolio management. This unique access enables hedge fund managers to navigate various market conditions with greater agility. They can utilize instruments and techniques that are either prohibited or impractical for traditional investment vehicles. Consequently, their approach to market participation is fundamentally different from conventional asset managers. Let us explore some prominent examples of these advanced strategies. One widely recognized technique is short selling, which involves betting on a decline in an asset's price. A hedge fund borrows shares, sells them, and hopes to buy them back later at a lower price, profiting from the difference. This strategy allows funds to generate returns even in bearish markets, providing a crucial diversification benefit. However, short selling carries unlimited risk, as an asset's price can theoretically rise indefinitely, leading to significant losses. It demands precise market timing and rigorous fundamental analysis. Another powerful tool employed by hedge funds is leverage. This involves borrowing capital to amplify potential investment returns. By using borrowed money, A fund can control a larger position in an asset than its own equity would allow, magnifying both gains and losses. While leverage can significantly enhance profits during favorable market movements, it also exponentially increases potential losses if investments decline in value. Prudent use of leverage is paramount, requiring sophisticated risk management frameworks to prevent catastrophic outcomes. Derivatives trading is also a cornerstone of many hedge fund strategies. Derivatives are financial instruments whose value is derived from an underlying asset, such as stocks, bonds, commodities, or currencies. Options, futures, and swaps are common examples. These instruments can be used for speculation, hedging, or creating highly customized risk exposures. Their complex nature demands advanced analytical skills and a deep understanding of market dynamics. Derivatives can provide powerful tools for managing risk or enhancing returns, but they also introduce their own set of intricate risks. Hedge funds also frequently invest in illiquid assets. These are investments that cannot be easily or quickly converted into cash without a significant loss in value. Examples include private equity stakes, venture capital investments, distressed debt, and certain real estate holdings. Investing in illiquid assets often offers the potential for higher returns due to the lack of easy market access and the premium for illiquidity. However, it also means that investors may face difficulties redeeming their capital quickly, especially during market downturns when buyers are scarce. This can create significant lockup periods for invested capital. The strategic goal underpinning these diverse approaches is to provide managers with a comprehensive toolkit. This allows them to construct portfolios that are adaptable to various market cycles and economic conditions. The aim is not merely to track or outperform a benchmark, but to generate consistent, positive returns. This concept is often referred to as absolute return. Unlike traditional funds that focus on relative performance against an index, hedge funds strive to deliver positive returns regardless of whether the broader market is rising or falling. This absolute return focus is a key differentiator and a primary reason investors turn to these funds for portfolio diversification and downside protection. The fee structure of hedge funds is a defining characteristic and a frequent point of discussion among investors. Unlike traditional mutual funds, which typically charge only an annual management fee, hedge funds generally employ a more complex two-part compensation model. This standard model is commonly known as 2 and 20. This 2 and 20 structure has become a benchmark across the industry, though variations certainly exist. Understanding each component is crucial for investors assessing the true cost of their investment. These fees are designed to align the interests of the fund manager with those of the investors, rewarding performance. The first component is the annual management fee, typically around 2% of the assets under management. This fee is charged regardless of the fund's performance, much like a traditional mutual fund expense ratio. It covers the fund's operational costs, including salaries, research, trading infrastructure, and administrative expenses. This 2% management fee is typically calculated and paid periodically, often quarterly, based on the net asset value of the fund. It provides a stable revenue stream for the fund manager, ensuring ongoing operations and the ability to attract and retain talent. The second and often more substantial component is the performance fee, which is typically 20% of the profits generated. This fee is usually calculated on any returns above a specified benchmark or hurdle rate. For instance, if a fund earns a 15% return and its hurdle rate is 5%, the performance fee would apply to the 10% gain above that hurdle. Many funds also incorporate a high watermark provision. This ensures that the fund manager only earns a performance fee on new profits, meaning they must recover any previous losses before charging a performance fee again. This mechanism prevents managers from earning fees on volatile, up and down performance. The manager incentives inherent in this fee structure are quite clear. The performance-based compensation strongly motivates fund managers to pursue high returns for their investors. A significant portion of their potential earnings is directly tied to the fund's success, creating a powerful incentive for outperformance. This structure encourages managers to take calculated risks and utilize their sophisticated strategies to generate alpha. It aligns their financial success with the growth of the fund's capital. The 2 and 20 model is designed to reward skill, innovation, and disciplined risk-taking in the pursuit of exceptional investment results. Investing in hedge funds, while potentially lucrative, entails a distinct set of risks that sophisticated investors must fully comprehend. These risks stem from their operational structure, investment strategies, and the very nature of the assets they hold. A thorough understanding is paramount for informed decision-making. One significant area of concern revolves around regulatory and transparency issues. As previously mentioned, hedge funds operate with less regulatory oversight compared to traditional investment vehicles. This reduced regulation contributes to specific risks, primarily due to the lack of standardized reporting and disclosure. Consequently, hedge funds are often less transparent than mutual funds, or ETFs. Investors may find it challenging to obtain comprehensive real-time information about the fund's specific holdings, trading strategies, and risk exposures. This opacity can make it difficult to fully understand the underlying investments and the risks they carry. This lack of transparency can hinder an investor's ability to conduct thorough due diligence and monitor the fund effectively. It places a greater burden on investors to trust the fund manager's expertise and integrity, relying heavily on their quarterly or annual reports, which may not provide granular detail. Financial risks are inherently amplified within hedge fund structures, largely due to their frequent use of leverage. While leverage can boost returns during favorable market conditions, it equally magnifies losses when investments underperform. A small adverse market movement can result in a disproportionately large loss of capital. The use of complex derivatives and other sophisticated instruments also introduces significant financial risk. These instruments can be highly volatile, and their valuation often depends on intricate models, which may not always accurately reflect market realities. Misjudgments in these areas can lead to substantial financial setbacks. Furthermore, hedge funds often invest in niche or highly concentrated positions. While this focus can yield high returns if the bets pay off, it also means that a single significant failure can have a devastating impact on the fund's overall performance and capital base. Diversification within the fund itself might be limited. Liquidity risks represent another critical consideration for hedge fund investors. Many hedge funds invest in illiquid assets, such as private equity, real estate, or distressed debt. These assets cannot be easily bought or sold without a substantial impact on their price, especially during periods of market stress. This illiquidity means that investors may face difficulty redeeming their investments quickly, even if they wish to. Funds often impose lockup periods during which investors cannot withdraw their capital, or they may have specific redemption gates that limit the amount of capital that can be withdrawn at any given time. Increased liquidity risk becomes particularly pronounced during market downturns or financial crises. In such environments, a surge in redemption requests combined with illiquid holdings can force funds to sell assets at distressed prices, further exacerbating losses and potentially leading to fund closures. This can trap investor capital and lead to significant write-downs. The performance of hedge funds is characterized by significant variability across the industry. While some funds consistently deliver impressive returns, outperforming broader markets and achieving their absolute return objectives, many others underperform, or in some cases, fail entirely. This wide range of outcomes underscores the importance of selectivity. There is no guarantee that a hedge fund will achieve its investment objectives or outperform traditional investment strategies. Past performance is not indicative of future results. And the highly dynamic nature of these funds means that a fund's success can be fleeting. Investors must approach performance expectations with realistic perspectives. Several factors critically influence a hedge fund's performance. Foremost among these is the skill and expertise of the fund manager. Exceptional managers possess superior analytical capabilities, deep market insights and robust risk management frameworks. Their ability to identify opportunities and navigate complexities is paramount. The chosen investment strategy also plays a pivotal role. Strategies like event-driven, global macro, or long-short equity each have their own risk-reward profiles and perform differently under various market conditions. A strategy that excels in one environment might struggle in another, making manager adaptability crucial. Prevailing market conditions further dictate performance outcomes. Bull markets often favor long-bias strategies, while bear markets can highlight the value of short selling or hedging. Economic cycles, interest rate environments, and geopolitical events all exert significant influence on a fund's ability to generate returns. Given these complexities and risks, hedge funds are not suitable for all investors. They are considered a sophisticated investment option, best suited for those who possess specific financial characteristics and a particular risk tolerance. Thorough consideration of these factors is essential before making an allocation. Investing in hedge funds requires careful due diligence. Prospective investors must thoroughly research the fund's management team, track record, investment strategy, risk management practices, and fee structure. This process should be extensive, often involving detailed questionnaires and direct engagement with the fund's principals. Furthermore, investors must cultivate a thorough understanding of the fund's specific strategy and the associated risks. This involves comprehending the nuances of leverage, derivatives, short selling, and illiquid assets. An informed investor is better positioned to monitor their investment and react appropriately to market changes. Finally, suitability criteria for hedge funds typically include having significant financial resources. This is due to high minimum investment thresholds, often in the hundreds of thousands or millions of dollars. Additionally, investors must possess a high tolerance for risk, acknowledging the potential for substantial capital loss, especially given the lack of liquidity. In conclusion, hedge funds are highly specialized investment vehicles, offering unique strategies and potential for absolute returns. However, they demand a sophisticated understanding of financial markets, a capacity for extensive due diligence, and a robust tolerance for elevated risk levels. They are unequivocally best suited for accredited investors and institutions seeking to diversify their portfolios with truly differentiated strategies.